In this video, we're going to talk about 30 great businesses that I want to buy in 2026. But, and this is a big but, only at the right price. So let me be very clear about something up front. We're not making this video to show off. We're not making this video to give you 30 stocks to copy. And we are definitely not telling you to run out and buy any of these companies today. That is not what this channel is about. What I'm doing is I'm sharing my watch list with you, and I'm sharing you my process. These are companies I believe are high quality businesses, the kinds that I'd be happy to own for a very long time because I think they'll be around for a very long time. And my hope is that at some point this year or the next year or whenever it happens, that the market gives me a gift and that these stocks go on sale because somebody else's trash becomes my treasure. And you'll see us talking about these stocks a lot more after earnings, after updates, and as the numbers change. And I'll keep running them through our stock analyzer tool and adjusting what I'm willing to pay as the facts change. So in this video, I'm simply going to show you the companies I want to own, explain what I like about each business, and share the price I'd be willing to buy them at today. Now remember, those prices can and will change. If a company's future looks better, if they start to grow faster, if it starts to slow down, or they surprise us with something in earnings that is going to be affecting them in the future, my valuation changes along with it. This is what makes us different as a channel. This is why I teach on YouTube. Everybody else out there sees a stock go up and says, that's a stock you have to buy. I sit there and I love it when I see a stock's fundamentals getting better, but the price going lower or staying the same. In the long run, stocks are a weighing machine, but in that short run, that voting machine is going to make the most popular ones go up and the least popular ones go down. What really matters, though, is how much money the business can make over time relative to what I've paid for it. Yes, growth matters. It's one of the most important parts and it's the first line of our stock analyzer tool, but price matters more. Great companies will become bad investments if you overpay. Stock number one, Microsoft. Guys, I love Microsoft. I've loved it since the 90s when it lost all its luster and people hated it and said it was a dead company even though it was still growing. It has now become a behemoth. And guys, their revenue growth keeps getting faster. I don't know how that's possible for such a large company. But here are my assumptions on Microsoft. Again, in all my assumptions, I'm using a 9% intrinsic value return here. I'm putting no margin of safety for all these companies. I'm trying to figure out what is this company worth based on the market. I hit the analyze button. Stock's currently at 476. I have a low price of 290, high price of 630, middle price of 430. Guys, I want you to remember, all these current price returns are based on a discounted cash flow model and includes the dividend. So don't add the dividend to this to get your total return. So I'm looking at it going, it's not far from what I think it's worth. But remember, I'm not here to buy companies for what they're worth. I want to get a discount. Stock number two, the Googly Moogly. Guys, Google has the top 2 search engines in the world, Google.com and a little known search engine called YouTube. That's right, this very channel. They advertise, it's an advertising agency, and they're all about the user. That's what I love about them. It's all about how do we give the user more than they're asking for. I love Google. Here are my assumptions on Google. Again, my 9% return. I put a little bit of a premium on them because I think it's a great company. The stock's currently at $315. I have a low price of $170, a high price of $530, middle price of $303. Guys, I want you to know something. This is why you pay a premium for good companies. I was loving this company at $150, but I wanted to buy it at $140. Look at it now. My lowest price is $167. It's pretty close to my middle price now. Should I pull the trigger? This is the hard part about investing. Stock number 3, Southwest Airlines. Guys, for me, this is purely a margins play. The last 5 years, they've made about 1.5% per year. Before COVID, they were making 10 to 15% a year profit. Look at these numbers. So I went and sit there and just said, hey, let's do 8, 11, 14% profit margin. That's it. I'm not even going to their highest levels. I hit the analyze button. The stock has surged recently to $42.75, but I have a low price of $62, a high price of $182, middle price of $110, and you better believe that I am selling cash secured puts on Southwest Airlines as we go along to build a bigger position. Stock number 4, Meta. Guys, half the people in the world use a Meta product, either Facebook, Instagram, Oculus, WhatsApp. And by the way, WhatsApp is far superior to iMessage. It's the best messaging app. I wish it would be adopted here in the US, but it's not, and that's okay. Here are my assumptions on Meta. The stock is currently at $662. low price of 473, high price of 1178, middle price of 754. Meta kills me because I was buying Meta sub 200 all the way down. I actually got lucky and bought at $88 a share on its low in November of 2022. And then I was stupid and I sold it at 195 thinking it ran up too fast. Let me take some profits and wait for it to fall. Huge mistake. It never fell back to that point again. I greatly regret that, but I'm not going to let it affect me because if this stock falls to 400, which in a reasonable bear market on the NASDAQ, that could easily happen. Okay, Alibaba. This is a company that everybody made fun of me for, but I sat there and said, China's growing. It's the biggest company in China, the best company in China. I gotta think they're gonna do well with it. They have a cloud computing business. I felt good about Baba, sub 100. A lot of other hedge fund people started to like Alibaba too, and now it has surged to 152. It got as high as like 180 or something recently. But here are my assumptions on Alibaba. Currently at 152, hit the analyze button. I have a low price of 110 to 134, high price of 340 to 400, middle price of 195 to 233. So still some meat left in this bone here. I lost it to covered calls at 165. At the time, I thought I was I lost it to covered calls at 140. At the time, I was devastated by it because it went up to 180 or so. But now it's coming back down. So hopefully I'll be able to buy it back with cash secured puts at 140 or lower. American Express, this is the elite credit card company with very high margins, not going away. As the world becomes wealthier and wealthier, I have to think American Express will be a beneficiary of this. Here are my assumptions. The stock's at 385. I own this, but I've owned it at a much lower price. And I'll be honest with you, I have that bias of the lower price. So it's scary for me to buy more of it. And I shouldn't have that thought because look at this. Based on discounted cash flow, I have a low price of 480, a high price of 1,078, a middle price of 722. So of course, I'm not going to lie to you guys. I sit there and look at it going, am I missing something here? Why are the prices so much higher than where it's currently at? And it's not like it's at, it's not like it's fallen 50% from its all-time highs. So that's interesting. All right, guys, Berkshire Hathaway. Now, this one cannot be put into Stock Analyzer. Why is that? Well, they have a lot of stocks. They have a lot of holding companies. Stocks are marked to market, so if they go up, they have to show a profit, even though it's not real profit, blah, 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 blah. What I look on this one is Warren Buffett once said, we'd be buyers of Berkshire Hathaway at 1.2 times book value. My guess is probably a little bit higher than that, so I'm just going to wait for that. What's book value? Assets minus liabilities. Done. That's your stockholders' equity. So at $1 trillion, you basically want $650 billion of book value. Let's go see what they have right now based on the balance sheet. Stockholders' equity, $700 billion. So he's probably a buyer of the stock at this point, potentially. But again, what happens in a bear? Am I trying to pick and choose and time the market? Maybe. But either way, Berkshire is not a typical stock analyzer company and Warren Buffett and Charlie Munger have said it. When we have a stock that goes up, even if we don't sell it, we have to report it as income. If a stock goes down, even if we don't want to sell it, we have to report it as a loss. That's not the right way to do it. It's the right way legally, but not the right way to look at it from an investment standpoint. All right, Apple. This is the company that a friend of mine once said that when he sees people giving up on Apple, he'll know we're near the end of a bear market. I agree with that. This is the company that'll keep on going. Everybody believes in it. As people come away from other companies, they'll go into Apple. Here are my assumptions. The stock's currently at 263, all-time highs pretty much. I have a low price of 120, high price of 285, middle price of 190 essentially. So I just got to be patient and wait for the right price. Okay, Visa, a lot like American Express, but for everybody. And of course, as the world gets bigger and wealthier, Visa is going to definitely get an advantage there. High returns on capital. I mean, look at this thing. It's awesome. The stock's at 356. Hit the analyze button. I have a low price of 211, high price of 570, middle price of 350. It's pretty close to my middle price. But again, I don't want to buy it for what it's worth. I want to get a discount on it. So I have to sit there and wait for the right opportunity. To follow that up, let's go to MasterCard, the counterpart. So I have all three major companies on my list: American Express, Visa, MasterCard. Guys, I think all these companies can do very well as the economy gets better. MasterCard is currently at $5.80 a share. I have a low price of $275, high price of $760, middle price of $420 here. Very high margin businesses. I love them. Let's go check out the next one. Home Depot. Guys, I look at Home Depot. Listen, I'm hardly a man, but I love going to Home Depot to sit there and talk and look at things and say, hey, what can I build? Even though I'm not building shit. But the point is, people go there Workers go there, contractors go there. It's not, I'm sure there'll be a day when people are doing deliveries, but Home Depot, I think, will be the one to sit there and lead that charge for their company. I don't think it's going to be Amazon. I could be wrong. They could figure it out. Maybe Amazon buys Home Depot. But here are my assumptions on Home Depot. Again, great returns on capital. Hit the analyze button. The stock's currently at $348. I have a low price of $240, high price of $450, middle price of $330. Now, guys, I want you to remember, there's a lot of red here. There'll be a time when it's all green. That happens all the time. What we want you to do is go on this full journey with us. Starting in this huge bull market, and we finally hit a bear market, to learn from us and to also realize that it will get better. So here's your homework. In the comments below, tell us the stocks that you want to own forever. And if you're a member of Everything Money community, share your list inside the general chat. And every month, between Sam and Dalton, we run multiple community live streams. They break your stocks down in Stock Analyzer and teach you how to make smart assumptions about the future of a business. At the end of the day, that's what investing is all about. Buying great businesses at great prices. And we're here to help you find them. Okay, Home Depot's counterpart, Lowe's. And I'm trying to figure out, I like Lowe's customer service better. You walk in the store, they're like, hey, how's it going? They ask you a lot more questions. So here are my assumptions on Lowe's. The price is $246 currently. I have a low price of $100, high price of $195, middle price of $140. So I got a ways to go here before it hits my price. Now, a company that I keep in business every single day, McDonald's. My assumptions on McDonald's are here. Again, really high returns on capital, the leader in fast food. Low price of $150 to $170, high price of $330 to $350, middle price of $220 to $240. So again, just got to be patient. Just got to wait a little bit longer for this. Now, a company that's a little scandalous. People were criticizing it for a long time. Go woke, go broke, Disney. Disney is a lot like Southwest. Had a profit margin issue, but they have tons of content. They own that content. I think they're going to win a lot of streaming wars. I believe they're still going to be the leader of a lot of these movies and a lot of these animated films and all that stuff. I still believe in Disney. I'm a believer. The stock's currently at 114. Based on my assumptions, I have a low price of 50, high price of 155, middle price of 92. I've been buying it, but back when it was in the 80s, and I was really excited about that. Now, not so much. Next company. A company that I was told over and over, you're missing it, they're going to get wiped out by AI. I don't agree with that, but the stock certainly does believe that itself. Another thing I like about Adobe, their free cash flow is significantly higher than their net income. Look at this. Look at these margin levels. Free cash flow, 41, 40, and 39% versus profit margin. People don't follow that free cash flow margin. This is a hidden gem, I think. The stock's currently at 334. Look at all this green. I'm going down here to the free cash flow, just kind of cash flow model. 380 low side, 820 high side, 560 in the middle. I think they're getting better from AI. AI has been surging for the last 2 years, and Adobe's revenue and profit are going up along with it. Another company, go woke, go broke, that when it was at 180, people told us we were crazy for saying we'd look at it a sub 100, and that's Nike. Guys, what kind of world would we live in where Nike's gone in 20 or 30 years? All these companies that I've mentioned so far, I'm just I would wonder what's going on with the world. Now, with large companies like this, it's hard to make outsized returns unless you're able to buy them during major mispricings. That's the hard part. I have Nike here. It's at $65 a share. I think it got to 58 recently. Hit the analyze button. We have a low price of 50, high price of 110, middle price of 75. So it's not screaming at these levels, but as it goes below 60, if it does during a bear market, I'd be very happy to own some. Now, another major brand here, one that I do not own in terms of either their product or their stock, Ferrari. But guys, Ferrari sells 14, 15,000 cars a year. They could easily sell 100, 200,000 cars a year, and they choose not to because they'd rather have demand. I love that. This is a car company that has 50% gross margins. What does that mean? Every car they sell, 50% of its profit for them. The average car company, 15, 18%. That's incredible. Their bottom line profit margin is higher than what other car companies make per car. That's incredible. So I look at Ferrari, currently at price at 372. I have a low price of 185, high price of 450, middle price of 290. So again, I got to be patient. I gotta wait a little bit. Now, when it comes to luxury goods, we don't stop at Ferrari. We don't even stop at Louis Vuitton, but that is a company we've got to watch. Why? They've got tons of luxury brands in them. Guys, look at all these brands that this company has, and they're growing. Now, my personal favorite is Hermes, but they're not publicly traded. So I look at Louis, and here are my assumptions. The stock's currently at $750. I have a low price of $530 to $580, a high price of $1160 to $1280, middle price of $750 to $850. So, guys, learn from me. All these companies in the last few years were selling for these much lower prices. That's what Buffett and Munger, I think, believe when they say, buy great companies and you might pay a little more than you want to, but it's worth it. I think Buffett bought Coca-Cola at 30 times earnings, which seems expensive. Now, my next company is in the financial services business, and it's a little bit tricky because I do believe a bad bear market will really wipe out a lot of gains in this company. T. Rowe Price. I have this company. They're a great 401k manager. The other thing is 401ks are very sticky. When your company joins a 401k business, it's very unlikely they leave any given year. It's a very tough thing to go and move. People push back. So I like this business. I'm looking at this from a very long-term perspective. Let me change my assumptions here to my 9%. The stock's currently at 109. I have a low price of 110. High price of 236, middle price of 163, based on free cash flow, based on earnings much higher. They pay a healthy dividend, but again, I do believe this company's profit and revenue will be hurt significantly in a major down cycle. And we're at major high valuation levels, so I would not wipe that out. Now, another company, Cleveland's own Sherwin-Williams. I was at a party the other day, and I didn't even realize the CEO of Sherwin-Williams was there. And it was like a small little event, 50 or 60 people. I don't remember her name, but anyhow, that's besides the point. Sherwin-Williams, this is the paint leader in the world. I don't think there's any question about that. The stock's currently at $340. I have a low price of $160, high price of $450, middle price of $265. So I got to wait, guys. I got to wait quite a bit. Now, another company, I love this business so much. I absolutely love this business. Generac. I love Generac. I own Generac stock. Oh, look at this. It's only at 145. I got to wait till like almost 200, I think. So hit the analyze button. The stock's currently at 145. I have a low price of 115, high price of 235, middle price of 165. So it's pretty attractive here. I got to update this watch list price. I'm going to update it to, let's go 130. That way it'll notify me when that happens. All right, guys. Every woman's dream, the Starbucks. These guys are going through some changeover. Very high returns on capital. The stock's currently at $90 a share. I have a low price of 60, high price of 115, middle price of 82. I was a buyer sub 80, still a buyer under 80. And as it goes further down, that's why I have it. This is how low it got, guys. I had it on my watch list. I kept putting it lower. But I'm going to put up my watch list at $80. That way, when it hits that price, I'll be notified and I can start selling more puts on these companies. Now, as I said earlier, each month we are on this journey together. When you see a video title, don't always take it word for word. Sometimes we have to play that YouTube algorithm game to bring new people in. That's just part of it. I can't get around that. But for you, our regular viewer, the person who watches almost Everything Money video, the goal is much bigger. Every month, we're working to eliminate stocks that are too expensive and focus on the ones that might be undervalued and worth your hard-earned money. We're teaching on this channel for one reason, to help you reach financial freedom and more importantly, to help you sleep better at night. To really get the full picture, you need consistency. That means being subscribed to the channel and watching our 4 videos that we put out each week. Over time, you're going to start to see the same process again and again. You're going to see real examples of what reasonable companies and stocks look like, what an overvalued stock looks like, and which companies might be so undervalued that you need to dig in deeper. This isn't just about one video. It's about learning that whole process and repeating it over and over until it becomes second nature. And then you know what you do at that point? You do what I do. You repeat even more. Here's a stock that you probably weren't thinking of, Otis, the elevator company. And you all know you get in that elevator and you see that Otis and you probably go, oh, that's where I've seen that before. Now, I'm going to say the elevator business and the elevator union is probably the strongest union I've ever seen in my entire life. The pains we go through, it's such a very unique skill set. They get paid absurd amounts of money. And there's only a handful of companies that can manage it. So it's so impressive, guys, that we owned apartment buildings. where we were trying to get elevators serviced, and we literally just said we're shutting down the elevator on a 3-4 story building because it just wasn't worth it to even fix it because of how expensive these elevator companies are. But obviously, if we had a 10-story building, you can't really do that. You have to pay for it. But on a 3-story building, guys, we can take the stairs, especially our stairs are very big. Anyhow, here are my assumptions on Otis. Hit the analyze button. The stock's currently at 90, low price of 46, high price of 103, middle price of 70. I'm going to change my watch list price. I'm going to put it at $70 a share. Not because I'm buying it then, but again, I want to do more research and make sure that I see what the new value is when it hits. Intuit. Guys, QuickBooks. If you have a small bit, guys, I use QuickBooks for my personal spending. I treat my personal spending and budget like a business. Income comes in, here are all my expense categories, and every single month I go with my wife and I bore her to death and say, hey, honey, we were under budget by blah, blah, blah. Hey, honey, we were under budget by blah, blah, blah. And she always responds with, great, more money to spend. And then she doesn't, which is great. But either way, I hit the analyze button on Intuit, who I love. QuickBooks Online's great. Stock's currently at $650. I have a low price of $230 to $385, high price of $560 to $908, middle price of $360 to $600. And as you can tell, guys, it's another stock where the free cash flow is much greater than its profit margin, like Adobe. Another stock that all these Charlie Munger wannabe value investors love, Costco. Munger said I would never sell Costco. And he passed away before he ever could. He was on the board. I believe he's on the board. Guys, great company. I personally believe too high of a price. It's currently at $900 a share, essentially. Low price of $300, high price of $600, middle price of $425. I'm going to add it to my watch list. I'm going to do $500 just to see what it looks like when it finally hits that, if it ever does. But remember, as it gets better, I'm going to adjust my assumptions and my price target. Another stock that I own, Target. Now, Target's gone through a lot of hell, and it's been a roller coaster of a stock. I started buying it at 130, went down to like 100, then it's shot up to 180, and then fell down to like 80. It's been all over the place. This is a company that's going through a lot of crap. Do I think it'll be around for a long time? Yes. Do I think the crap they're going through is temporary? Yes. So to me, that is an opportunity. If you have what you think is a temporary problem that people are exaggerating, that could be an opportunity. That's the way I see it. You might not see it that way, and I don't blame you. But the stock is currently at $104 per share. I have a low price of $106, high price of $250, middle price of $170, guys. So this one is pretty interesting along the way. I should be selling monthly puts on this bad boy. Now, guys, another great retailer that every woman in the world loves, TJ Maxx, but they have more than TJ Maxx there. They have a lot of other companies involved, but let me change my assumptions to 9%. Hit the analyze button. Guys, I have a low price of 50, high price of 88, middle price of 65. So at 155 currently, it's a problem for me. Now, I'm going to add it to my watch list. I'm going to change the watch list price to $65 a share because it's gotten better since the last time I did that. Now, guys, Sprouts Farmers Market has been a roller coaster. I bought Sprouts at 31 to 33. I lost it to covered calls at 165. It went to like almost 200. I was like, son of a gun. But now look at this. Just remember, this is a phenomenal company, guys. This company has great margins for a grocery store, and they're increasing the margins of their stores by doing more and more Sprouts Farmers Market brand products that have really high margin. I think this company is wonderful. I did a 10-year analysis. It's currently at $77 a share. Don't get attached to the low price you paid before. Because look, now my low price is 96, high price of 220, middle price of 150. This is showing some major upside here based on my assumptions above. It's something I have to go sell covered cash secured puts on. Now, another boring company that you probably know of but don't know of, Cintas, the uniform people. These guys make uniforms. These guys do like rugs and buildings and all that stuff. The stock's currently at 188. Nice, boring company. I have a low price of 81, high price of 170, middle price of 120. It's actually above my high price right now. So I'm going to change my watch list price to 120 just to keep an eye on it as it falls. Hopefully we have a nice bear market here soon. Now, Johnson & Johnson, J&J. Let's pull this one up. Stock's currently at 205. Boring company, doing my 9% return. Analyze button, 106 on the low side, high side of 190, middle price of 150. I think it has a healthy dividend. Let's see what that dividend is for those of you who love dividends. But right now, this dividend's 2.5% on what I think is an overpriced company. So Just going to be patient. I'm just going to keep on waiting. Now, another great company that a lot of people out there should love, Hershey's. Look at Hershey's. It's currently selling for $180 a share. Good old boring Hershey's. Hit the analyze button. I have a low price of 108, a high price of 200, middle price of 150. I need to adjust this current price. I'm going to add it to my watch list at 150 per share. Shows you how long it's been since I adjusted those prices. That's why it's important, guys. If you're in the community, make sure you go in here every 6 or 9 months and look at your stocks and edit the prices by running Stock Analyzer. Companies change as time goes on. And a company kind of similar to to Johnson & Johnson is Procter & Gamble. Procter & Gamble is another everything company. Stock's currently at 140. Low price of 75, high price of 135, middle price of 100. So guys, that company right there, it's nothing sexy, but you got to get a good price for it if it's not going to be a grower. So if you'd like seeing my list of 32 stocks, wait until you see what I did next. I handpicked 7 stocks that I believe will beat the Magnificent Seven over the next 10 years. And I'll be honest, even I was surprised to see last year's results. So you're going to want to see who made that list. Click the video on your screen right now. Thank you for your time.